These are unsettled and wild times right now. And for many investors, the extreme volatility in both the stock and bond markets so far in 2022 has been painful and downright scary. And as we move through the fourth quarter, real estate values have sharply declined from their highs. The stock market is down almost 20%. And rampant inflation has caused economic pain for many everyday Americans as the cost of groceries, gasoline, and everyday goods and services has skyrocketed. We can discuss and debate the reasons for this economic weakness until we're blue in the face. But the fact of the matter is, we have no control over these issues. And at Towerpoint Wealth, we believe that economic and market pullbacks, while uncomfortable, can and will happen and have always proven to be temporary. Nonetheless, this year's instability has many investors asking themselves a few poignant and important questions. Are we in a recession? Or if not, is a recession looming? How do I protect myself and my investment portfolio during a recession? And at least for some forward-thinking investors, how can I take advantage of a recession if and when one happens? If you have asked yourself any of these questions, then this video is for you, as I'm going to discuss 5 crucial things you can do to help recession-proof your portfolio. Hi, my name is Joseph Eschleman, and I am the president of Towerpoint Wealth, a boutique independent wealth management firm headquartered in downtown Sacramento. At Towerpoint, we recognize that the news cycle is 24/7, and we certainly do pay acute attention to what is happening. However, we are rarely reactionary to the shorter-term movements, some might say noise, of the financial markets. Traders and speculators care much more about and scrutinize the daily, weekly, and monthly action that the markets continue to offer. However, at Towerpoint Wealth, our philosophy is to help our clients be disciplined and take advantage of market and emotional extremes rather than fall prey to groupthink and the herd mentality. But how exactly would this strategy and philosophy help to recession-proof your portfolio? Well, you're about to find out. First of all, let's set the record straight. Economic expansions have historically been bigger, longer, and more robust than recessions. And concurrently, bull or good markets have historically been bigger, longer, and more robust than bear or bad markets. Over the past 73 years, bull markets have lasted longer, about 50 months on average, than bear markets, which have been about 13 months on average. Now let's keep these facts in mind as we get into things today. To be clear, our economy is by no means recession-proof, and it would be ignorant to believe that bear markets cannot and will not happen. And at Towerpoint Wealth, we believe that rather than worry about them, it is instead better to recognize, or perhaps better said, embrace these risks and to have a plan to not only protect against them, but to leverage and benefit from them. Okay, enough about strategy and philosophy. Let's get into it. What can you do to help recession-proof your portfolio? Number 1, own and have exposure to blue chip equities or stocks. Investors almost always find blue chip stocks to be attractive, but especially during a recession. They typically pay attractive dividends, which provides a tangible return in the form of consistent income. Blue chip stocks also represent ownership in larger, more established companies that have more stable and predictable streams of revenue and profits, which can help lessen the impact on the price of a stock during a market pullback or recession. 2. Harness the power of low correlation investments and alternative diversifiers. Owning or adding investments to your portfolio whose price and value tend to zig when more traditional stocks and bonds zag can help lower the risk and volatility of your portfolio, especially during a recessionary period. Commodities, precious metals, timber, commercial real estate, crypto, hedge funds, private equity, private debt, fine art, all just a few examples of low correlation alternative investments. 3. Increase your exposure to non-US equities. Owning international stocks is another way to help recession-proof your portfolio. While the economies and stock markets of many of the major developed countries and economies around the globe seem to be more correlated than ever before, the discounted valuations and currencies that oftentimes can be found within international stock markets can be an excellent hedge against a possible U.S. recession. Additionally, international markets oftentimes offer more exposure to structural growth opportunities than the U.S. market and can be an excellent hedge against rising inflation here in the U.S. 4. Cash is still king. Cash adds bubble wrap to your portfolio, especially during a recession. Having cash helps an investor to further recession-proof their portfolio by cushioning against volatility and market declines. Smart investors can also use cash to take advantage of attractive investment opportunities as they typically arise during a market pullback or correction. Cash is considered oxygen for a portfolio as it becomes more important to have when temporary market declines occur. Lastly, while checking, savings, and money market accounts have just paid little, if any, interest over the past few years, things are quickly changing, and as interest rates on savings accounts continue to sharply rise throughout 2022, you should earn higher yields on your cash and money market deposits. Our fifth and final way to recession-proof your portfolio: be humble about your ability to accurately predict the future and instead be properly diversified and rebalance your portfolio. It's almost a cliche now to mention diversification, but it's still true that by maintaining a portfolio allocation across a diversified group of asset classes, investors can position themselves and their portfolios to better weather market and economic volatility. Additionally, being properly diversified affords you the benefits of disciplined portfolio rebalancing, which helps an investor to not trade based on emotion and to help recession-proof your portfolio by buying low and selling high when strategically transitioning back your portfolio to its original targets. Empirical studies have shown that portfolios that are strategically rebalanced in a disciplined fashion have experienced lower volatility and higher risk-adjusted returns. Is your head spinning yet? There is a lot to consider. And to be clear, market pullbacks, economic recessions are difficult. They're painful and stressful. We haven't met anyone who enjoys experiencing declines in the value of their real estate and investment portfolio. However, it is also important, we actually argue essential, to be aware of and have a clear understanding that recessions and bear markets can and will occur. Once this inevitability is internalized, it becomes emotionally easier to deal with and manage through them. Now, it is fair to assume that your lifetime wealth building and wealth protecting journey will be sprinkled with pullbacks and recessions. And at Towerpoint Wealth, we believe that a true marker of your longer-term investment success is not avoiding them, but instead accepting that they happen and how you prepare for and leverage them when they occur. Have you enjoyed this video? If so, be sure to click the thumbs up button below. Thank you for your time and attention, and if you'd like to receive high-level financial and wealth-building content like this, hit that subscribe button to subscribe to Towerpoint Wealth YouTube channel and hit the bell to receive an automatic announcement when our next educational video drops. Thank you.